More pressure to corn and less for soybeans, last minute shift in acres, and the marketing strategy set by Michael Zuzolo, who is back to Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. Hello, Mike. How are you today? So, do you think that the USDA report will bring more pressure to corn and less so for soybeans?
Well, I don't think it should, Luis. It may in the short term just because of the way the trade has been trading the market recently. But I think fundamentally, if you look back at what we've talked about over the last several months, several things are holding, I think, that probably need to be thought about again in the midst of the train wreck of a day that we saw on the day after the report, where a report where the bull, not only did the bull not get fed, but we also had a major supply chain issue and bottleneck here in the United States on the Mississippi River, which, if memory serves me right, it's responsible for about 60+% of all of our exports in grains. We had a bridge over the Mississippi River in Memphis, Tennessee, that was shut to not only traffic on the highway on I-40, Interstate 40, but it was also shut to all barge and river traffic. And the last number I saw before we came on air here was there was a couple hundred barges backed up at this point that couldn't get south with corn on it. And so these are the types of things we've gotten used to, unfortunately, in the world of COVID, supply chain issues. So between that and the Colonial Pipeline starting to reopen and a 4% loss in the crude oil markets, that brought in the funds to liquidate long positions. And having gotten two big inflation reports out of the way this week, it sure looked like to me the investors wanted to buy the rumor and sell the fact. I think you're at a point now where what still holds true in my analysis is that, like we talked about, the grains are probably going to be the best opportunity to sell and hedge the first half of the calendar year of 2021. The livestock, probably the best opportunity will come the second half of 2021. To get back to your question and wrap it up, the USDA, I couldn't agree more with in terms of their corn number for Brazil of 102 million tons. That was a 7 million ton reduction. We should get in the United States almost all that business, minus whatever wheat could be substituted. But there again, that's something that holds too that we've talked about, that wheat will be a competitor to corn because of the spread. USDA recognized that, said that, in fact, in their report, and said it would be probably the greatest competitor since 2013 from June through August. And so then that takes us to the Brazilian crop and the soybeans. USDA's 136 million metric ton number unchanged. That still seems high to me, but I'm not going to fight it at this point. I'm going to assume that Brazil is going to have much more soybeans to bring onto the world market and compete with us effectively with China, against us with China, than they will corn. And if we're talking about importing anything in the United States Southeast for the livestock industry, I think it would be beans, much greater likelihood than the corn at this point.
Well, prior to the report was released, two consultancies have reduced a lot more the Brazilian corn output. But on the same day of the USDA report, CONEV came out with a report that reduced just slightly the Brazilian possible production.
Yeah, and this I think goes back to the official agencies. And I was talking to a colleague about a week or two ago about CONAB and about USDA, and his understanding was that USDA officials essentially trained CONAB in how they come up with their estimates. And because they do that, the USDA doesn't want to deviate too much from CONAB, even if they see something different on satellite imagery or the boots on the ground with the USDA ag attaché. They're probably not going to deviate from CONAB because they have a very good working relationship with one another, and they use the same metrics and probably the same statistical methodology, or similar to what USDA uses. And so I think that's important to keep in mind. And I think it's also important to keep in mind what the cash prices do and whether the USDA export sales from here on out start to see a reduction in US sourced soybeans and a real pickup in the month of May and especially June, a real pickup in soybeans sourced out of Brazil and to a lesser degree Argentina, based upon what the prices are right now. One thing the United States bean crop and bean market has going for it, or has had going for it, is a soft, very soft dollar. And that seems to be changing, and seems to be starting to be attractive to being bought, mainly because U.S. interest rates look like they're heading higher because of this inflationary pressure. So if we'd see the dollar start to move higher, I think that could speed up the sourcing change from U.S. sourced beans to Brazilian and Argentine sourced beans. Something to look at over the next 30 days.
So are you thinking that the Fed interest raises would happen still this year?
You know, Luis, I've been doing a lot of research on that. I think what's probably going to happen is either the Federal Reserve will come in August or September and start talking about raising rates the first of the year and work the market back and push back on it and kind of take away the punch bowl lightly, as we like to say when you're at a party. Taking away the punch bowl means you take away the lubricant and the social lubricant of the alcoholic beverage. And so if they take away the punch bowl, I would think they'd probably start talking about it in the fall of this year. But I think they're going to wait for another month or two of continued inflationary pressure, which I think they'll get because this inflation tends to be kind of a lagging indicator and kind of a building indicator that once it starts, it tends to continue to feed into the numbers the way they collect the data. So I would say that's part of the metrics and the analysis that I've tried to use when I talk about hedging grains more aggressively between now and summer. And then the last half of the year, start worrying more about the macroeconomic conditions and frictions from the Federal Reserve. I've even started to consider the idea that we may even have price controls. If the energy prices go any higher, especially with the Colonial Pipeline coming back online as of this afternoon, the day we're taping on Thursday afternoon, if energy prices continue to go higher in the summertime, watch out for your summer driving season and watch out for your summer grilling season. And I wouldn't be surprised to see the federal government kind of resurrect what we did in the very early 1970s of maybe putting in some price floors so that the companies can't charge any more than an X amount. I'm not ready to say that yet, but it's something I'm doing research on right now.
So would you say in a more casual scenario that the U.S. corn and U.S. beans wouldn't be that competitive against the Brazilian farmer?
I think that it's a situation of substitution in terms of competition. And again, it goes back to a 100 million. I think that the Brazilian corn crop's closer to 100 million metric tons, in part because of some of the information that you've been good enough to share and help me with from the boots on the ground in Paraná and other provinces in Brazil. And so I think between the Argentine corn and the Brazilian corn, I don't think price is going to be as sensitive or as elastic in terms of determining where importers buy from. I think they're going to try their hardest to utilize wheat, but here again, and utilize DDGs. But here again, I was just looking before we went on air, Luis, we're looking at a 7 to 8 year high in DDG prices right now in Illinois for the cash market. There's not a lot of substitutes to substitute corn with, except for the wheat and that new crop wheat that will be coming off here in about 60 or 70 days. So I think it's more economic theory will work better with soybeans, less so with corn.
Yes, and are you ready for a last minute shift in acres in the US?
I think that I'm ready for bigger soybean acres, and maybe a little bit bigger corn acres, but I do think that there's been a slow enough pace in certain parts of the country, and we still have a drought in the northern plains where there's a lot of oil seeds and quite a bit of corn as well. That I don't know whether the producers will really attack it and go after the big acres like I thought maybe 2 or 3 months ago. It's certainly something, and this is probably the capstone or the most important piece of the grain market for me. We've talked about sell and defend. We've talked about selling it as it goes higher, because if you try and sell it after a high is made, you're catching the knife. You're trying to catch the knife and say the high is in, but then you go lock limit down like we did on Thursday in the corn market, and you say, well, I can't sell it, so I'll wait another day. All of a sudden, you start to change your psychology of what you're looking at. Profit per acre. So what we want to do is consider that profit per acre and reevaluate your marketing plan in the middle of the year and continue to defend your sales, because I do think the stocks, the USDA showed us the stocks are still very tight. To go from 120 million bushels of old crop beans to 140 million bushels is not a big jump. And the same with the corn and the average prices that they gave us. Keep an eye out for that as well. But keep profit, keep the sell and defend model intact, and then reevaluate in about 2 months.
Yes, and another thing we talked about was the driving season. I think we are 1 month away from the driving season in the US. What do you think is going to be the impact?
Well, I think it's getting worse. I think the demand to drive and the demand to fly and the demand to eat out is there, but I'm getting more and more high frequency information that suggests that the consumer is not going to be met with a supply that they can get a hold of. In other words, restaurants can't get a hold of enough labor, hotels can't get a hold of enough labor. Prices are very high. We've gotten close to $3 a gallon in gasoline now here in the country, and that's very much higher than it was a year ago. So it's not looking as good as it could look. I still think it'll be better than last year, but I'm not sure how much. And so again, like the grains, for the next couple months, I'm real eager to get hedges in place on the livestock, especially the cattle market, and especially since we've had a rally in the cattle. Right now, the cash cattle are trading around $120 in the Southern Plains, and the futures in June is around 115, Luis. So there's no hedge there. You've got a discount and a cheaper price in futures, so it's not a good hedge, in my opinion. Just stay current on your marketings. But if we would see June and August rally up to the cash and maybe get above the cash, then I'd start looking at hedges.
Well, watching some conversations about the inflation in the US, I think you are between a rock and a hard place right now, because some governors are talking about of cutting some unemployment help, but at the same time that a lot of workers are staying home. On the other hand, they will reduce their spending if the help is cut.
Yeah, and I think you bring up a huge point. In the midst of the unemployment issues in the states trying to open up, we've also seen major companies like McDonald's announce that they're going to raise their wages dramatically. So that's already going to happen. That's going to start happening. And so that wage inflation is coming, and that's only going to cut back on the small businesses' profitability. Small businesses in the restaurant industry cannot compete with McDonald's for the same labor pool. And that's what's going to hurt us, I think. And that's where I would not be surprised that you and I, in a year from now, would be talking about a global recession or a US-led recession because of some of the things we're building up right now at this time period. So time is of the essence to get back on track economically.
Yes, we also talked over this half year a lot about wheat upsides, but what are you seeing for the midterm and the longer term in terms of this commodity?
Yeah, great question. I think, well, all the grains are, it's very important. On Friday of this current week, we'll see the May futures go off the board and the July takes over. The May futures has best represented the cash market and the demand and the rationing effect. and it's kept a premium in price. Some big premiums like corn, not so big, and say soft red wheat, and maybe not as big in the hard red wheat, but it's a premium nonetheless. And the structure of that market would say if July continues to go higher after the May goes off the board, we should be able to get one more move up before harvest in wheat. It's a move that I'd want to hedge because I do think even though crop conditions for the hard red wheat crop are down 7 or 8 points from last year on good to excellent, it looks like there's a lot of rain coming in the next 10 days for the majority of the wheat crop. And so I think the potential for bigger yields is very much there as long as we don't see disease pressure. So I think that it's still, again, like the beans, the wheat market, I think, is on the top tier of wanting to hedge if we get a turnaround and get to the upside. I've got roughly on the wheat and the corn about 50% of my 2021 hedges in place. For brokerage clients, 30% of that, 25% of that is in bought puts. And so for cash clients, I'm about 30 to 35% sold on wheat and corn. I need to step it up on wheat if we get another rally.
Yeah, and I would like to get your viewpoint on the crisis in India. India is the largest soy oil buyer in the world. And do you think that at some point that would affect the soybean price?
I do. I think the soybean oil is a very treacherous market right now because we are not only rationing demand because it's an edible oil and consumers cannot tolerate and governments cannot tolerate to subsidize vegetable oil prices for too long. Vegetable oil is almost worse than higher fuel prices and you put in your motorbike or your car. So I think you're really cutting demand off quickly in the vegetable oil market. And you're right. I think the demand, the consumption in India is going to show a dramatic slowdown for all foods because of what they've gone through with the COVID. And I think the other thing that I would say to you too is I've been doing a lot more research about the supply chain, and I was staggered to read in the Financial Times about a week ago that about a third of all global seafaring mariners or men that work on ships are from India. And so we are looking at a very serious supply issue because a lot of these ships are parked and anchored off of the docks and away from the docks, so they can't be loaded and unloaded if they've got Indian mariners on it. And so this is just part of this just-in-time supply chain that's come in and just haunted us for the last year. I think it's just going to make goods more expensive. Well, you may be wondering, why are you bringing this up? Well, because we just hit a 10-year high in the Baltic Freight Index. That Baltic Freight Index means a lot to somebody wanting to buy corn or buy beans and ship it halfway across the world. So these all work into the dynamics of what our demand is going to look like 6 months down the road.
Yes, and you can add to that the low levels of the Paraná River in Argentina. The Paraná River ships most of the soybean production from Paraguay and Argentina, and sometimes ships soybeans to get processed in Argentina.
Yeah, and this is the confounding part about the bean oil versus the bean meal. I've got to think fundamentally the bean meal, the soy meal market, because Argentina is the number one exporter in the world year after year of soy meal, that soy meal is undervalued compared to the soybean oil. And that the funds, especially because of their green energy mindset and wanting to do the vegetable oil biofuel type buy on their investment portfolios, I've got to think sometime down the road here in the not too distant future, we'll see them want to unwind some of that because the meal market sure looks undervalued if our number one exporter in the world can't move beans and meal out of their country.
Yes, and I want to hear your thoughts on marketing for the livestock producer.
Yeah, as I said, I'm going to stay very close to keeping marketing's current in the cash for the cattle right now. Feeders, I'm very eager to get some more feeder cattle hedges in place if we can get up a little bit more. Livestock, I've really just decided to leave the livestock hedging alone between now and August because of some of the new news we're getting about African swine fever out of China. It just doesn't look like they're rebuilding their herd, and that they're going to have to continue to import quite a bit of pork from us and other countries. And so I don't think there's a need to hedge quite yet. And maybe once the June contract gets a little bit more dated, I'll look at the hogs, but I'm really focusing on cattle. Probably the biggest thing to talk about in the livestock, and I'll save the best for last, Louise, is the idea that a lot of cattlemen are telling me they're really getting crimped by the higher corn prices. We're getting a big break right now that I'm going to recommend buying into the December corn futures. I'd love to get it down around 5.25 to 5.50 on the board price, recognizing that USDA's average price that they just gave us this week on their report, for the first time we saw their average US price of 5.70. So if I could take 25 cents off of the 5.25 futures price, I'm essentially going to be able to hedge corn 70 cents below the average cash price by USDA. So I'm very eager to get that done for these next 6 months.
I wonder how many hours of research you do, Mike.
Well, how many hours are in the day? And then you subtract 6 for sleep.
Thank you, sir.
Thank you, Luis.